This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 9, 2026, and this is the After Hours session. Now, let's get into it. The Fear and Greed Index has plummeted to 14 out of 100, marking a fearful regime that is actively reshaping capital allocation across global markets. While equity indices like the Nasdaq managed to close higher on Wednesday, the foreign exchange desk tells a starkly different story. Risk-off flows are dominating, with safe haven demand propelling gold to 4,061.64 and pushing dollar-yen toward 162.462. The disconnect between equity resilience and currency stress sets the stage for a volatile evening. Looking ahead, the market's attention is fixed on a single high-impact event, the Reserve Bank of New Zealand's interest rate decision, arriving tonight. This is the primary catalyst for the Kiwi dollar, which has already surged over 1% today. Beyond the RBNZ announcement, the week closes with a notably light economic calendar for Friday, July 10, meaning overnight volatility will be driven almost entirely by central bank rhetoric and geopolitical developments, rather than a flood of domestic data releases.
And with that light calendar, we need to watch the RBNZ decision not just for the rate itself, but for the accompanying guidance. If the statement hints at prolonged tightness, it could exacerbate the current risk-off sentiment already fueled by the Iran headlines.
To set the scene, let's look at the macro landscape as of July 9, 2026, at 1914 ET. We are seeing a severe divergence. The labor market reports robust non-farm payrolls growth of plus 57,000 month-over-month, yet the broader sentiment index has collapsed to that 14/100 fearful reading. This is being driven by a flattening 10-year minus 2-year yield curve spread of positive 0.38 percentage points, which historically precedes caution, even as core PCE remains sticky at 3.41%. In the FX space, we're seeing safe haven bids in gold and the dollar, while commodity currencies like the Australian dollar face pressure. Let's dive into the drivers of this fear. The core issue here is a dangerous decoupling. You have resilient economic data, real GDP at 2.9% and unemployment at 4.2%, but the market is pricing in stagflationary risks. The Fed funds rate sits at 3.62%, which feels insufficient given the 4.17% CPI print. This policy trap means rate cuts are delayed not because the economy is crashing, but because inflation is sticky. That's why we see the trade-weighted dollar index declining 0.46% week over week to 120.69, even though leveraged funds are increasing their net long DXY positions by 4,438 contracts. Speculators are betting on a stronger dollar than the broad index reflects, anticipating that the Fed will hold rates higher for longer to battle that 4.17% inflation.
That speculation is playing out technically on the charts, specifically in dollar-yen. As of our last update, the pair is at 162.4615, having dipped 0.5% in the last day. It is currently trapped in a consolidation zone just beneath the critical 5-day high resistance of 162.71. We've seen this level rejected twice in the last 5 sessions, forming a localized distribution pattern. The pair failed to sustain a close above 162.71 on July 8, closing at 162.54 before retreating. Meanwhile, the VIX is compressing within a tight 15.53 to 17.3 range, which suggests the market is coiling rather than expanding volatility. The immediate momentum looks neutral or bearish as price action struggles to clear that 162.71 peak without fresh geopolitical fuel.
But I'd argue grid is looking at the wrong volatility gauge. While grid focuses on the VIX range, the real risk is in the fragmentation of risk-off flows. The VIX is at 16.13, which is surprisingly contained given the 14/100 fear score. This masks a structural fragility where equity resilience is decoupling from FX stress. Look at gold. Gold is at 4,061.64, down 0.36%, and hovering near the lower bound of its 5-day range at 4,021.74. The fact that gold is consolidating near its low, despite the fresh explosions headline from Iran, suggests that safe haven bids are being absorbed rather than accelerating. We aren't seeing a broad-based panic. We're seeing a selective rotation into specific hedges while ignoring broader exposure. That's a liquidity trap waiting to snap shut.
Let's examine the headlines moving the needle right now. First, geopolitical tensions are escalating. Forex Live reports fresh explosions heard in Iran, coinciding with statements from a U.S. official that talks will continue on nukes. Second, we have a direct clash on the inflation front. U.S. June existing home sales came in at 4.9 million, missing the 4.2 million expectation, yet CPI remains at 4.17%. And third, crude oil is running to a new session low, adding to the deflationary pressure signals. On the Iran situation, the key takeaway is that neither side sounds eager to escalate, according to the latest reports. This ambiguity is keeping the fear score high, but not spiking it into chaos. The market is pricing in a wait-and-see mode, which reinforces the safe haven demand we're seeing in dollar yen and gold. The lack of immediate resolution keeps the 10-year 2-year spread flat at 0.38%, trapping the yield curve in a state of suspended animation.
That suspension is dangerous for positioning. The CFTC data shows leveraged funds are holding a massive net short of negative 115,400 yen contracts. That's an extreme structural imbalance. With the Iran headlines creating uncertainty, those yen shorts are incredibly fragile. If the U.S. Treasury auctions off $22 billion of 30-year bonds at a high yield of 5.058%, as reported in the headlines, it could tighten dollar liquidity further, forcing those short yen positions to consider covering. We're seeing a rotation theme where risk-off flows favor dollar and yen over Aussie and Kiwi, but the Aussie leveraged funds are still net long 31,777 contracts. That contradiction makes the Aussie-yen cross a flashpoint.
And don't overlook the silver lining, or rather, the silver lag. Silver is at 57.848. While gold consolidates, silver is holding its ground, but it's not leading the charge. The fear is concentrated in the safe havens, not the industrial metals. The real risk flag here is that the VIX compression means options premiums are cheap. If those yen shorts decide to unwind simultaneously, the move won't be a gentle drift. It'll be a liquidity vacuum.
Let's drill down into the specific currency pairs driving this narrative. Starting with dollar yen. It's at 162.4615, reflecting that safe haven bid. Grid, you mentioned the 162.71 resistance earlier. Is there a technical case for a breakout, or is that ceiling holding?
The case for a breakout is currently weak. As I noted, the 5-day high of 162.71 has been tested and rejected. The intraday range is compressed. The high is 162.572 and the low is 162.361, which signals a coiling spring effect but not necessarily upward direction. The support level at 162.076 from July 8 remains intact. A break below that would expose the psychological 162 handle. Until we see a decisive close above 162.71 accompanied by a VIX spike above 17.3, the technical structure favors defensive positioning. Buyers are exhausted at the upper boundary.
Grid, you're looking at the chart, but I'm looking at the flow. The reason that 162.71 ceiling is hard to break isn't just technical, it's because the underlying leverage is already maxed out. The net short of 115,400 yen contracts means there's very little room for new speculative buying to push the price higher. If anything, the upside is constrained by the fact that the traders who would normally buy the breakout are either already fully positioned or are afraid to add to such crowded shorts. The DXY leverage is up 4,438 contracts, but that's a broad dollar play. The yen short is specific. If the yield curve flattens further, those shorts become a liability, not an asset.
Exactly. And SPECTER here will add that the VIX range of 15.53 to 17.3 is suppressing the very volatility needed to trigger a liquidation cascade. If the VIX doesn't breach 17.3, the fearful narrative is just noise. But if it does, and we see that yen short position start to flip, the move in dollar-yen could be violent. Right now, though, the data shows consolidation. The 162.71 level is a brick wall, unless the macro regime shifts from fear to panic.
Moving to Aussie yen, it's at 112.6595, highlighting the tension in the carry trade. CIPHER, you mentioned the Aussie is strongly bullish with net longs. How does that interact with the yen shorts?
It creates a fragility hotspot. Aussie leveraged funds are net long 31,777 contracts, while yen is net short 115,400. This means the Aussie-yen pair is essentially a bet on both sides continuing their respective trends. But if the fear regime intensifies and we have fresh explosions in Iran, that tends to crush carry trades. The Aussie is a risk-sensitive currency. The yen is a safe haven. Even though Aussie longs are building, the broader rotation is towards safety. If the RBNZ decision tonight is hawkish, it might support the Aussie temporarily, but the structural crowding of yen shorts remains the dominant risk factor. One bad headline, and that 112.6595 level becomes a launchpad for unwinding.
Technically, Aussie yen is sitting at 112.6595, and it's closely tied to the dollar-yen dynamics. If dollar-yen gets rejected at 162.71, Aussie yen faces similar resistance. The correlation is strong. If the yen strengthens broadly due to safe haven flows, Aussie yen will drop, putting pressure on those Aussie longs. The key level to watch here is whether Aussie yen can hold above 112. If it breaks below that, it confirms the carry trade unwind is starting in earnest.
Let's talk about Kiwi dollar. It's at 0.57233, and we know it's up over 1% today due to the RBNZ anticipation. Apex, how do you view this move in the context of the broader risk-off environment?
Apex here. The Kiwi dollar move is fascinating because it defies the general risk-off tone. Usually in a 14/100 fear regime, the Kiwi dollar gets sold off alongside the Aussie. Instead, it's rallying. This suggests the market is pricing in a very specific outcome from the RBNZ, a hold, or perhaps a dovish tilt that surprises to the downside relative to the hawkish Fed. The key is to watch the RBNZ decision not just for the rate, but for the forward guidance. If the RBNZ signals that they are done hiking, while the Fed is stuck at 3.62% dealing with 4.17% CPI, the interest rate differential could shift in New Zealand's favour. This is a localised opportunity amidst global caution.
I agree, Apex, but I'd challenge the idea that this is purely a local Kiwi story. The Kiwi is up 1% because the Kiwi dollar is nearing a key technical support level, likely around 0.56 or 0.57, and traders are positioning for a bounce. However, the macro backdrop is still hostile. The 10-year two-year spread is flat at 0.38% globally. If the U.S. data continues to show sticky inflation, the Fed's 3.62% rate becomes a floor for global yields. That caps the upside for Kiwi dollar unless the RBNZ explicitly diverges from the global trend. The risk is that this rally is a dead cat bounce before the broader risk-off wave returns.
Technically, looking at Kiwi dollar at 0.57233, we are testing a resistance zone. The 5-day high is not explicitly listed in the daily snapshot, but the 1% gain suggests we are approaching significant overhead supply. If the RBNZ decision is interpreted as hawkish by the broader market, the pair could quickly retrace to the 0.565 area. The volume on this move needs to be monitored. If it's thin, it's not sustainable.
Finally, let's look at gold. Gold is at 4,061.64, down 0.36%. SPECTER, you mentioned earlier that gold is consolidating near its low. Why is gold fading despite the fear regime and Iran headlines?
Because the fear is already baked in. The 14/100 score is rising from 12 over the last 7 days, meaning the anxiety has been building for a week. By the time the Fresh Explosions headline hits, the smart money has already bought the dip. Gold dropped from a 5-day high of 4,203.23 to 4,061.64, and now it's hovering near the 5-day low of 4,021.74. This indicates profit-taking or consolidation. The market isn't panicking, it's digesting. The real risk is that if the VIX stays suppressed below 17.3, gold loses its momentum. It's acting more like a stablecoin in this moment than a chaotic hedge. The safe haven bid has shifted to the dollar and the yen, leaving gold in the middle.
And from a flow perspective, silver at 57.848 isn't helping much. Precious metals usually move together. The fact that silver is lagging gold suggests institutional money isn't aggressively rotating into the complex right now. They're sticking to the primary hedges, dollar and yen. So gold at 4,061.64 is essentially in limbo. It's waiting for a clearer signal from the Fed or the geopolitical theater.
We've covered dollar yen, Aussie yen, Kiwi dollar, and gold. Apex, tie this together. What is the defining characteristic of this session?
The defining characteristic is the quiet storm. We have a 14/100 fear score, fresh explosions in Iran, and a flat yield curve, yet the VIX is suppressed and equities are closing higher. This creates an illusion of stability. Grid correctly identified the technical resistance in dollar yen at 162.71, and CIPHER highlighted the fragility of the 115,400 yen short position. Together, they suggest that any upward move in dollar yen is capped by overcrowded positioning, while downward moves are limited by safe haven demand. The RBNZ decision tonight is the spark. If it triggers a yen short squeeze, the 162.71 level breaks. If it doesn't, we remain in this consolidation trap. The key is watching the DXY leverage flows versus the trade-weighted dollar divergence. If they converge, the market wakes up.
So the key takeaways for this evening. First, the market is in a fearful 14/100 regime, but volatility is suppressed, creating a fragile equilibrium. Second, dollar yen is facing strong technical resistance at 162.71, backed by extremely crowded yen shorts that pose a squeeze risk. Third, the RBNZ decision tonight is the primary catalyst for Kiwi dollar, potentially offering a localized rally amidst global caution. Tomorrow, with a light calendar, we'll watch how these positions adjust. Thank you for listening to the ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.